Hey everybody, my name is Paulo Brantz, owner of Clear to Close Brokers. Really excited to put this together for you. In this video, we're going to talk about some common mistakes home buyers make. We're going to talk about the market as it relates to housing prices. We're going to throw in a little bit of 2008 foreclosure. We're also going to talk about interest rates, what the future is, and where we think everything is heading. And let me just, and then also at the very end, we're going to talk about, some appreciation and rent versus own. So a lot of stuff we're going to cover. And let me just kind of just give you the answer here. As we progress, what you're going to find is because of the limited supply of homes and of interest rates starting their downward decline, you are going to see some upward pressure in housing prices simply because when you have increased demand with more buying power and a limited supply, there's nowhere to go but up here. So, okay, let's get started here. Let's start first with one of the first common mistakes that I see first-time home buyers make. Not even first-time home buyers. I take that back. Home buyers in general, because the first question I always get asked, well, I would say about 80% of the time when I meet somebody new that is looking for a home is, what is your interest rate? See, the biggest conception out there is that when you're talking to a loan officer, they'll quote you a rate, and people actually think that is the rate that they're going to get when they find a home, put an offer in, and get their offer accepted. That's the rate they're going to get. That's not true. You see, interest rates are actually traded on an open market. Think a mortgage-backed security. So think stocks. Every day they're going up, they're going down. Some days they're big gains, some days there's all this other stuff. That is the same way with 30-year fixed rates. The only time that you can lock in your interest rate is once you get your offer accepted on a particular property. Now, if you got your offer accepted on a property, then you locked your rate, then you decided not to buy that property, unfortunately, you can't take that rate with you to the next property. It's actually property specific. Now, there are programs out there like Lock and Shop that will allow you to lock in a rate while you search. But in this market, you're going to pay a lot of money for that rate, and it's just not competitive at all. So it doesn't even make sense. So they shouldn't even have it, truthfully. So there it is. So we talked about when you can lock your rate. Also, 30-year fixed rates versus the Fed's fund rate. A lot of times in the news, you're going to see your Feds increase the interest rates. More often than not, I would say about half of the people I speak to think that when the Feds increase the rates, 30-year fixed rates go up proportionally. The Feds control short-term interest rates, such as home equity line of credits, credit cards, short-term stuff in nature. Now, they do have an impact on 30-year fixed rates as they, increase the short-term rates. It fights inflation. We'll get to that in a little bit. And that's going to decrease interest rates, but they're not directly related at all. In fact, when the Feds are increasing the rates, we actually saw 30-year fixed rates go down. How it affects your pre-approval. See, this is a little bit hard to explain, so just stick with me for a second. You're actually not pre-approved to a purchase price. It just makes it's a lot easier to describe it, what you could shop for, but what you're really pre-approved to is a payment. You see, lenders, we have to look at, there's a formula. We have to look at your total debts, right? Your total income. And basically, just in general, we have to be at 50% or lower. So as interest rates increase, that's going to put an upward pressure on your payment to keep that same purchase price, which is going to put that purchase price down. And so you're actually losing buying power when interest rates go up, which is actually really powerful when you consider that rates have doubled over the last 2 years. And you're going to see that the housing market the housing prices have really only gone down 3% from its peak, even with doubled interest rates. It's crazy. Now, as interest rates start to decline, you're going to see people's buying power, including yours, start going up, which is going to put more money in people's pockets, give them a little bit more that they can offer. So good news, bad news, right? All right, our next slide here, we are going to take an actual look at what it looks like on the open market. This is mortgage-backed securities and how they're traded. And if you take a look here at the line, I gave you guys a good day here because green is actually positive news as mortgage-backed security MBS prices go up, interest rates go down, and then vice versa as mortgage-backed securities go down, interest rates go up. Why this is so important, why I wanted to share this with you, is that going back to that first comment, you think you're locked into a rate until you get you think you're locked into a rate when you're really not. Let's take a look at this situation right here where we had somebody looking at a house and they put an offer in on day 1. And day 3, when the market totally changed, they got their offer accepted and were able to actually lock in interest rate. You're talking about 100 basis point different. Let me give you an idea what that means. That means if I was offering you a 5.99 right here, and then when your offer was accepted here, that rate went from 5.99 to about 6.3 to 6.5%, or it's going to cost you 1 point. That's why it's so important that as you're shopping for homes, that you're working with somebody that's going to keep you updated on the market volatility. Because, here's my favorite saying: I do not like surprises. Surprises that's not true. I love surprises, but they're for birthday parties, not for when you're buying a home, and certainly not for interest rates. So you always want to make sure that you're staying attuned to what's going on in the market, because I showed you here, it could really change really rapidly. Mistake number 2 is, they've done their research. They come to me, they go, I love this house. I can afford it. It's great. Then when I calculate the payment, they're like, wait a second, why is your payment so much higher than ours? Well, let's take a look here. Let's break this down. So before I did this, I went on to Zillow, not trying to pick on Zillow at all, but this is just a website I went to. There's a property on Albatross Drive here in Novato at 1.1 million. And if you scroll down here, there's a monthly cost button that will give you a breakdown of your principal and interest, of your property taxes, of your homeowner's insurance, of your HOA dues. And they have an estimated monthly cost for this property, and I believe it's with 20% down, of $6,622. Well, here, let me share with you a little bit of what I come up with my conclusion. Hang on, I'm doing a webinar. Oh, come on up here, buddy. Let me share with you guys I got to sign something here. Let's see if I can multitask while I do this, right? So here's my calculation. So if you look at the same purchase price of 1.1, 20% down, you're going to have a loan amount of 880. And then what you're going to do, sorry, man. Thank you. He's the greatest guy. I'm sorry, man. I appreciate it though. So at 880, so I'm using their interest rate of 6.335 here. So the total payment, principal and interest, is 5,467. So we're the same here. But look at the property taxes, 1,146 compared to their $706. Homeowners insurance is totally crazy. There's no way it's $385, but I'm just going to mirror theirs as well. Then you have an HOA of 64. I come up with $7,062. That is a $440 per month difference in what the actual cost of this house is going to be versus what this website shares you or shows you what it's going to be. That could be a problem when you're trying to budget for a house, and that could be really hard on your realtor and lender if you're working off wrong information here. So what is the solution for all this craziness? I'm just gonna throw it here, and I'm gonna move my head here because I actually love this little hopes and dreams. Here's the thing, right? A lot of people think that when you talk to a lender, you have to apply for a loan, you have to upload all your docs, you have to give them the world before they give you any answers. That's not true. Here's the thing. I want to make it simple for you. I want to make it easy for me. We have these hopes and dreams meetings. They're absolutely free. I'm not going to ask for your credit. I'm not going to pull documents, no applications. We're just going to make sure that you're operating off the correct information, the correct payments. We're going to go over high-level overview of buying a home. It's really simple. And you guys, I've been doing this for 20 years. I can nail it down what your best program is for you, whether it be a down payment program, FHA, conventional VA, in a matter of 10 minutes versus looking on the internet and trying to Google yourself. Last time I tried to Google a symptom for myself when I had my knee injury, I thought for sure I needed knee surgery, when in fact, I just needed ice and some aspirin. Don't tell Danielle that. I milked that one for a while. All right, let's talk a little bit about the market. Let me get some tea here because my voice is already starting to go. Let's compare. Let's talk a little bit about, the 2008 crash. A lot happened in 2008 that is not happening today. On this wave here, you saw foreclosures. This big tidal wave or tornado, you saw subprime lending. You guys, I was doing loans in 2007. Here's what you needed to get a loan for whatever loan amount you wanted. Ready? This is it. That's it. You just needed a breath. Then they would give you a loan, because what they were basing everything at is appreciation. Watch The Big Short. It's a really good movie. It really explains this, because the loans today are nothing like the loans back then. Right now, in fact, you have to qualify for everything. People have equity. It's not the same at all when it comes to 2008 to today. In fact, let's go over some major differences. Number one, let's talk about inventory, because remember, that is huge. You have to have inventory, right? In 2007, there was only 4 million units, 4 million homes for sale, as compared to today, 980,000. You guys, that is a huge, 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 huge. Let me say it again, huge difference. Active home sales listings in the US, it's gone up a little bit. And here we are, January 2023, which is actually, this is seasonal, you guys. This right here is seasonal. As we head into the summer, you're going to start seeing more people put their house on the market. We should see listings going up. But here's the thing. We're about 10% lower than where we should be, which unfortunately is going to limit our supply. And as you're going to start seeing, as interest rates start to decline, now we have even more limited supply. That's where that upward pressure in housing prices is going to come from. All right, before we get there, let's talk a little bit about the overall market when it comes to home prices, because there was a dip in home, and you're going to see that in a second. But let me give you some highlights, some overviews, right? So right here it says CoreLogic up 0.8% in February. This is the housing market. Up 0.8% in February, up 4.4% year over year. And then next month, they're forecasting another increase of 0.02. Now, that is a small amount of increase, but it's 2 months of increases. That's what's key there. FHFA is up. They saying that the housing market is up 0.2% in January, and Black Knight 0.2 in February. So these are all different types of people, different types of organizations that measure appreciation and non-depreciation declines. There it is. So since the peak of 2022, home prices are down from Case-Shiller 2.95%. So I rounded that up to 3% in some of my other slides here. Black Knight has the market down 2.6%. FHFA has it down 0.6%, 1.6% from CoreLogic. Now, that is a far cry from a market crash. So even the worst case scenario, Case-Shiller, which is 3%, is only showing 2.9 or 3%. What's the difference between Case-Shiller and FHFA? Case-Shiller also measures cash offers. Now, if this makes sense. When you buy a house with cash, you do get a little bit of a discount, and there's houses out there that you can only buy with cash that are below market, right? But like unlendable houses, flips, and stuff like that. All those are being incorporated in Case-Shiller, and still with all that, we're at 2.95%. Since 2022. All right, over the last 10 years, we're up 116%. 2 years prior to the peak, we're up 40% in housing prices. So here's the thing. This is the one slide I told you I changed it to 3%. So here is FHFA, or no, this is Case-Shiller, excuse me. This is the appreciation since 2012. Now, as you can see, let me move my nice little head here. As you can see, this is when the pandemic started. We had that really nice increase right here. And we're actually, if we're able to extend this out, we're probably about right here in about 2023. So we're still on that decline. But here's the thing. Have we hit the bottom yet? I know a lot of people are trying to, to really time this to where we can hit the bottom of this right here before home prices go up. But let me leave you with a thought here, right? As we go down and we hit that bottom, we're going to start going back up. So in theory, if we're right here and you bought here and you lost value because it didn't hit the floor yet, and then it went back up and eventually it got to where you would buy, where you bought, excuse me, which person would have it better in terms of putting their offer in? What I mean by that is, would it make more sense for you to put an offer in here, or would it make more sense for you to put an offer here after we hit the bottom on the upward slope? Well, this is really interesting because if you were hitting on the downward slope, the sellers are typically more fearful because a lot of people aren't putting offers on their property. There's less competition. You're most likely to get some of your fees paid for, right? You can actually negotiate. And by the way, right here, interest rates will probably be a little bit higher here. So not only can you negotiate and get some of your costs paid here, but here, you most likely are not going to be able to negotiate. There's going to be much more competition because rates are going to be lower. And you may actually, start off bidding down here and end up buying here. And by the way, if you bought here, getting all those credits, I hope this makes sense. I wish we were like in person right here. Getting credits, getting some of your closing costs paid for, you can always refinance once rates gets lower. So what I'm trying to illustrate here, this is a really powerful slide that on this downward trend, probably a better time to get your offer accepted than on this side of the curve. All right. Let's talk a little bit about mortgage rates and recessions, right? So now as we're heading into this recession, let's see what interest rates have done in the past once we get into recession. Well, if you look at 2000, oh, my thing always pops up here. So 2008, 2019, 2008, 1980, 1982. We look at 1990, 2022, 2008, 2020. All of them, once we enter the recessions, interest rates have actually declined from 16 to 11.75%, from 18 to 13%, 11 to 8.75%. In every single recession, interest rates have improved. But what about housing prices? Well, that's a great question. Let's take a look at the next slide here. So in housing prices, it's the same thing. So these dark areas are the recessions, and here's the housing prices. All of the recessions, except for one, housing prices have stayed the same or they have increased, except for one. That's in 2008. But I want you to take note. The housing crisis actually caused the recession. The recession did not cause the recession did not cause the housing crisis. It's a big distinction there. So what's holding rates up? So as we enter into the summer, why is everyone predicting, and why are we so confident that interest rates are going to go down? Well, it has a lot to do with inflation. Before we get to the slide, inflation is the kryptonite to 30-year fixed rates. And there's two types of measurements of inflation. There's PCE and CPI. Now, a part of the measurement of CPI, right, is going to be shelter costs. But the interesting thing, let me move my head here. The interesting thing, and I'm not a smart guy. I'm sure there's a reason for this, but how they measure shelter costs is not the cost today of what the costs are. It's an average of looking backwards. So when the numbers today actually have 12 months figures included. So even though check this out, you're going to see this in a second. Even though shelter costs today are lower, because we have to include 12 months ago, all the figures 12 months ago and average it out, it actually is appearing higher, which is keeping inflation up, which is keeping 30-year fixed rates up. You see, this is the actual apartment list rent year over year change. You can see here, you can't see the date there, but this is about 12 months ago that the cost was actually at its highest. The rent was actually at its highest. And so as we start calculating, I'm so sorry. So as we're calculating today's shelter cost, today's CPI, today's inflation numbers, we have 1 year ago this figure included in that. So it's keeping it artificially high. But as we progress towards the next upcoming months and into the summer, do you see what happens here? That number dramatically declines. That's going to show meaningful declines in inflation. And as a result of showing meaningful declines of inflation, the bond market is going to do well, and you're going to see interest rates start to really improve. I mean, this is a great visual of it. I was just at Six Flags this weekend. I'm still a little sick, but here's real shelter costs. It's on its way down, but shelter costs and how it's calculated in CPI, even though it's on its way down, it's still getting bigger and bigger and bigger until eventually enough time has passed to where those lower figures can come in and it's going to start shrinking. And that's where we're at. So this month, so we're in the month of April. I predict, this is the prediction, and this is not just me. I get it from Barry Habib. This guy is absolutely amazing. That the consumer price index is coming out this week, and I actually expect it to actually show inflation increasing, even though it's not. This gets tricky. I hope I can explain it well. So inflation numbers are going to go up, but actual inflation is going down. But we don't care about what's actually happening. We look at the actual report, and that's going to put an upward pressure on interest rates. Why? Because in that average, then that calculation, March of last year number was really low. You see in February, it was 0.5. In March, it was 0.3. So this 0.3, which is keep the numbers low, is actually being replaced by a higher number today. And because of that higher number, the average is going to be skewed, and it's going to look like inflation is rising, but it's not. So you see, next month in May 10th, circle that date. This is when we're going to start seeing interest rates really start to decline towards the summer. End of summer, you're going to see them about low to mid fives. Because of this number is no longer an issue, and we're starting to take higher numbers into calculation, then you're going to see inflation start to decline, and you're going to see rates follow. It's kind of crazy, isn't it? Oh my God. It's like eye rolling. Like, I don't even get it, but there it is. All right. Betting against a champ. Now, here's the one thing. I love this. The housing market. This is a great slide. This is a great one. You never bet against a champ. The housing market, since 1941, when it looks at wins, losses, and ties, it's 73, 7, and 1. It rarely loses. People think that because prices have gone up in 2022 and 20 and 2021 by large amounts, there must be a drop. We've had many periods like that. Take a look at 1943 through 1947. Home prices went up 118%. After that, home prices went up for 43 more years without a drop. Through 74 and 79, home prices increased from up 93%. After that, home prices went up another 10 years before going down only 1% in 1990. Then another 14 consecutive positive years. Everyone focuses on 2007 through 2011. Inventory was 4 million in 2007 versus 980 today. Much different lending standards, you guys. I mean, everybody that gets a loan today is approved. And by the way, when you want to talk about foreclosures, I can't see anybody foreclosing with a 2% rate with tons of equity. It just doesn't make sense. It's just not the same. It's not the same playing field. All right, let's talk about some fun stuff, right? Because the good news is, though, even though we are expecting a little bit of competition, it's still a great time to buy. Single-digit appreciation can create great wealth for you. So this is Marin County here. And by the way, I can give you a report for any county, most cities, major cities, right? So if you have any figures that you want me to run by you, just send me an email. I would love to send it off to you. But in Marin County, over the next 7 years, it's expected, forecasted to appreciate 5.28%. Well, that doesn't sound like a lot, but let's take a look here and see if it's a lot. So let's say you bought a house today in Marin for 1 million. So this is historical. I'm not going to focus on historical, right? But you can see they're pretty close, right? In 7 years, if you sold that house, you would be able to sell it for 1.4 million. Now that's $415,000 in gain after you pay your fees to get the loan. Now that doesn't include realtor fees to sell it, but that's a lot of money in just 7 years. $418,000. Wow. All right. So the same property, let's do a rent versus own in that same 7 period. I'm just going to give you the highlights. If you want the breakdown, let me know. I'd be happy to send it to you. So this big red negative number does tell you that by renting from a cash flow, monthly cash flow perspective, you would have paid $57,000 less, right, over that course of the period, which sounds like a lot. But let's take a look at the big numbers and as it relates to buying a home. So number one, you're going to have $433,000 of appreciation gain in that same 7 years. And amortized gain, it's going to be $83,000. So what that means, the net gain by buying a home, that means the amortized gain, what you pay down, then you have to subtract that $57,000 cash flow. That's going to be net positive too. That's $413,000 in your pocket. That is actually, it does include that cost to sell, forgive me. So that even includes realtor fees when you sell the property. So here's the deal. So in conclusion, I hope what I've shown is that, you know, what we're being seen on the media in terms of, you know, the housing crash, it's just a way to pull you in and get ratings. If you look at the numbers, if you look at the why, especially where rates are going in the housing forecast, you know, right now, you know, could be the best time to buy, especially if we haven't hit that bottom. You almost don't want to hit that bottom before you buy, because once you do hit that bottom and it starts that upward trend, that's usually a sign that rates are down, there's more competition, you know, and it becomes more and more of a seller's market. Not that it's not already, but more of a seller's market. All right, lastly, hopes and dreams. If you want to schedule a hopes and dreams meeting with me, I would love to. Let me know, send me an email, and I'll send you out my calendar link. You just book it. We'll just go over your goals. We'll see, you know, what you'll leave after that meeting is about what you'll be qualified for, what the actual real payments are going to be, how much cash to close you need, anything and everything. We'll get it answered for you. So there it is. I hope this was helpful. If you know anybody that would like this information, let me know. All right, you guys. Paulo Brantz, losing my voice, Clear to Close Brokers. Take care. Bye.